Welcome, everybody, and thank you for joining us. Today's topic is one that is top of mind for treasurers and finance leaders alike. The topic for today is the Fed's next move and whether you're positioned for it. So here's where we'll go today. We'll open up with quick introductions, start with the Fed's recent rate cut news, then we'll move into what treasurers should expect if cuts occur. We'll review the impact on different instruments and provide clear takeaways to ensure you're prepared. And then finally, we'll end with a Q&A. So please feel free to add any questions that you have into the chat via the Q&A box at the bottom left of the screen. So to quickly kick off the introductions, my name is Rachel Green. I'm a senior sales executive at Jiko, and day to day, I help treasurers and CFOs match their cash strategy with the right solution. And the reason I'm here is to really bring that perspective into today's conversation. And so Lisa, with that said, let me hand it over to you.
Thanks, Rachel. Hi, everyone. My name is Lisa Husken. I'm a principal value engineer at Kyriba, and with over 15 years of treasury management experience, I collaborate with treasurers, with CFOs, as they evaluate their current treasury operations and assess what the impact and value a treasury transformation leveraging Kyriba would have on their organization. Chris?
Thank you so much, Lisa. My name's Chris Murray. I'm the head of liquidity at Jiko. Among other things, it means I run the broker-dealer, which is where all the treasury trading actually happens, as well as all the flow of funds. My background is actually equities. I was a quantitative trader on Wall Street for 15-ish years, and I'm happy to be able to get to join Jiko in the last few years.
Thank you, Chris. We're so excited about the presenters we have today that have a wealth of knowledge and insight to bring to our discussion. So without further ado, let's go ahead and get into the meat of the topic today. So starting with rate cut expectations. So as we all saw, there were no rate cuts in July as many had expected, but the market still anticipates cuts before the end of the year. With the next Fed meeting actually on September 16th and 17th, Chris, Lisa, I would love your perspective here. What's the most important thing you're watching as we head into September?
Yeah, well, I guess to step back, the last meeting was interesting because we actually had two dissenters, which is something that hasn't happened, if I remember, in something like 30 years. So there were two people who did want to do the cut, yet they didn't. The market very much expects a cut in the September meeting. The question will be how much?
Yeah, I agree, Chris. Powell has been a little bit more vocal about a potential rate cut, citing recently that the baseline outlook and shifting balance of risks may warrant adjusting our policy. And I think that's really some of the first indications that we've seen that he's hinting at a rate cut. So at this point in time, personally, I don't think it's if there's going to be a rate cut, more what size of a rate cut we're actually going to see in the coming weeks. So.
Absolutely. Well, let's go on now and talk about market expectations. So Chris, I will let you go ahead and take this one.
Yeah, absolutely. So let me set some background here. People have probably heard about the market's predicting a certain amount of rate cut. The market has expectations. And I want to talk about exactly what that means. So we have here a chart that shows what the projected rate cuts were going to be, what the expectation was at the end of August. And as of that time, there's an 85% probability of a cut down to a range of 400 to 425 basis points for the Fed funds rate. But the market still had a 15% chance of no cut or rates being steady at 425 to 450. So what does that actually mean? When we say the market expects a rate cut, what are we talking about? Well, there's a product called a Fed funds futures contract. And that's where traders trade hundreds of billions of dollars a day betting on what Fed funds is going to be in the future. And based on the prices of those contracts, we can actually back out what the market's expecting. And you can see when the market expectation changes, you'll see the prices of those contracts trade. So here we're using what people call the wisdom of the markets. And the idea is that all these people betting all these billions and tens and hundreds of billions of dollars on Fed funds rates, there's an incentive to get it right. So market expectations are probably the best predictor we have of what's going to happen in the future.
Chris, that's really interesting. And for everyone listening today, if you're in the corporate treasury space, what Chris just said really underscores how much the futures market is shaping expectations, not just Fed signals. So while we can't predict the exact timing or magnitude of cuts, what we can do is prepare. So let's talk about what treasurers should expect if rate cuts occur. Starting here, we'll use this time to break down what a rate cut would mean for treasurers from cash instrument returns to liquidity. So starting with cash instruments, Chris, can you walk us through what happens to treasuries in a rate cut environment?
Yep, 100%. So here we're going to focus specifically on a subset of treasuries, which is T-bills, because that's what's going to be the most relevant for our treasurers listening in. T-bills are very short-term debt issued by the government, and they're issued at a discount, and the price goes up over time, and they mature at a price of 100, and that's how they accrue interest. So what we've done here is we've drawn a somewhat exaggerated chart showing what happens to T-bills in different rate cut environments. And here on the bottom of the chart, on the x-axis, we've got the number of days to maturity. And as we move to the right, it goes to 0. And on the y-axis, we've got the T-bill price. And the way T-bills accrue interest is by the price going up. And when rates change, or when there's a rate cut, it changes the trajectory of the price increase of the T-bills. So here we've got a couple examples. And it's really important to distinguish between an expected rate cut and an unexpected rate cut. So we just described what an expected rate cut means. Now we're going to show how it impacts T-bills. So if you look at the red line here, we'll see that anytime there's an expected rate cut, the T-bills price is going to appreciate or accrue interest at a higher rate until the cut actually happens. And then once the cut happens, the T-bill simply accrues interest at a lower rate. So that's why you get that kind of curved or bow shape you see in red. Now, what might happen is if there's a surprise rate cut, the reaction is actually going to be quite different. So if there's a surprise rate cut, that's what we're showing in the yellow line. If there's a surprise cut, what will happen is T-bill prices will gap up. So all of a sudden you'll have one day when prices jump in response to that surprise rate cut, and then the future rate of appreciation is going to be slower. So in the surprise rate cut scenario, the people who bought the yellow T-bill before the cut, they earned a bunch of money the day that surprise came out, and then they later accrue interest at a lower rate. So it's really important to make that distinction. But regardless of if it's a surprise or not, after the cut, all new T-bills are going to have the lower rate. So that's sort of the constant. Is going forward, your long-term rate is going to be lower. And long-term bonds are a bit more complicated, so we're not going to address those here.
Well, Chris, that's fascinating. So treasuries react not just to cuts, but to whether those cuts are expected or a surprise. So let's go ahead and talk about what we expect to happen to money market funds and deposits in a falling rate environment.
So these are a little bit simpler. Money funds typically have a price of $1. The price doesn't change. So when you deposit or withdraw, the price is always $1. And you're going to see the change reflected, unlike treasuries, not in the price, but in the yield. After SEC changes in the past few years, almost all money funds have a very, very short weighted average maturity. And simplifying a little bit, that means they're going to respond pretty quickly to a rate cut. So if there's a rate cut, you're not going to see the price change like treasuries. Rather, you're going to see the yield change. And typically, if it's an expected cut, that drop in yield is going to be quick. So it'll probably happen within a few days. If it's a surprise cut, then similar to treasuries, you might have 10 or 20 days left over at the higher yield. But ultimately, in the long run, yields are going to adjust to the newer rates, just because money funds at the end of the day often hold a lot of treasuries. Bank deposits can be a little bit different because at the end of the day, it's at the bank's discretion what rates to pay. But typically, they're going to respond to rate cuts because their own profit opportunity is impacted by it. So if the money that the bank earns and their reserves goes down, then they're going to offer less to their depositors. So rate cuts are bank deposits probably look a lot like money market funds, and that the yields will most likely change pretty quickly.
Excellent. Okay, well, let's go on and talk about what we saw in March of 2020 to kind of present a case study of what we could see in the future. So if we go back to March of 2020, the Federal Reserve had just made 2 emergency rate cuts in response to the COVID-19 crisis, first lowering rates by 50 basis points to 1 to 1.25% on March 3rd, and then slashing to near 0 to 0.25 on March 15th. Chris, could you share how the rest of the market reacted at this time?
Yeah, so this was very much a standard flight to safety. So flight to safety is money goes out of risky things into safe things. Money out of equities in a sense. S&P was down 34%. VIX, the volatility index, went up. And in our sort of money fund treasury world, money went out of the less safe less perceived safe money funds like prime money funds and tax exempt funds, and money went into T-bills. They're always perceived as the safest asset, and also into some of the treasury money funds and into deposits at safe banks. So this is the typical experience when things get scary. Everyone's scared, move money out of the risky things into the safe things.
And I think this is a great opportunity to bring up the impact on organizations that may actually have debt on their books. We've been talking about organizations that might have some cash in terms of investments into T-bills or money market or CDs, but a lot of what happened in 2020 still has a lingering effect on corporate ledgers today. So if we kind of take a step back and take a look at what corporations were doing, aside from the flight to safety, right? They were also ensuring that they had the liquidity and financial flexibility to sustain some of that economic uncertainty. Kyriba actually publishes a biannual liquidity performance benchmarking report where we take a look at trends and take a look at how U.S. corporations with revenue of $1 billion or greater kind of react to the market. And what our latest publication showed us is at the beginning of this year, so beginning of 2025, the current portion of long-term debt rose by nearly $73 billion. And that's actually in a direct correlation to what happened in March of 2020. So not only did they have that flight to safety, but corporations also increased their liquidity reserves, often through 5-year term loans, and really in order to take advantage of those historically low rates that Rachel was talking about, 0 to 0.25%. So what's happening now is that those loans are coming due. So treasurers and CFOs are really faced with the decision today of what to do with this maturing debt. So, if they have excess cash, great, they can pay down those loans. But a lot of times, if they don't have that excess cash right now, they're going to be forced to refinance that debt. And considering where the rates are today, they'll be refinancing at much higher interest rates. When you take, billions of dollars of debt from 0% to now 4, 4.25%, 4.5%, it's really going to have an impact on those organizations. So I think if the Fed does determine that they're going to cut rates in September, which, as we've discussed, does look probable, that's going to really help to mitigate the impact and the strain on some of these corporations as they're facing and having to refinance some of this still outstanding debt. So we've talked a lot about the potential impact that interest rates have on organizations and their strategic decisioning moving forward. But none of these assumptions, none of these speculations really mean anything without data, right? In order to really ensure that we are accurately able to advise the potential impact on Treasury, it's essential that treasurers and CFOs have access to timely and reliable data. So while data integrity is important, I think what's more important is the ability to present that data in a digestible and actionable format. And that's really where Kyriba's functionality comes into play. Kyriba's managed connectivity. We're able to provide real-time data consolidated because they're not sitting there wasting time data mining, data cleansing, information from multiple sources. What we've seen here at Kyriba, many organizations are really moving from more of a cash forecasting to more of a liquidity planning. So really trying to take a look at how to model various scenarios, leveraging all of their data. So their cash, your investments, your debt, your FX exposure, how that all comes together in a liquidity planning platform that enables finance organizations to really, present multiple different scenarios, be able to demonstrate what happens if we pull on multiple levers and really demonstrate these what if scenarios. So I think it's important for the treasurers and CFOs on the line to really focus on what are we doing with our overall working capital, and how is that going to be impacted by some of these potential rate cuts, and really having an ability to kind of demonstrate that and to what if scenario model that is really important to be able to provide that to your decision makers for strategic decisioning. And the one thing I do want to mention as well is AI. That's the buzzword now, right? I am constantly have customers ask me, well, what's Kyriba doing with AI? And I'm sure you, Jiko is having that as well. But I think what's more important than worrying about what we're doing with AI is what's your data strategy? Because you have to have reliable, trustworthy data in a strategy in place surrounding that before you start thinking about leveraging AI. AI enhances, your liquidity planning. It'll enhance your decision making by automating data normalization, by simulating your cash flow scenarios. It can analyze very complex data sets. But what we have to make sure is that the effectiveness of AI as it relates to strategic decision making, it's directly linked to the integrity of your data source. So as you're thinking about some of these potential rate cuts, as you're taking a look at how that is going to impact your organization, I think it's important to make sure that not only are you basing that decision on real-time reliable data, but if you are bringing AI into the mix, to make sure that your AI is being trained on and making decisions and suggestions based upon that real-time data.
So I love what you said. I think AI strategies and data strategies are top of mind for almost all of the treasury and finance professionals that we're speaking with today. So let's go ahead and talk about the key takeaways from our session. To round things out, lower yields are on the horizon. Rate cuts pull returns down across instruments, but history shows that cash tends to migrate towards the safest, most liquid options. So how can we prepare? First, we want to do scenario planning around multiple rate paths. Secondly, we want to model after-tax returns at lower yields. Third, we want to stress test liquidity needs under different cut scenarios. And fourth, we really want to weigh whether your policy allows enough flexibility to adapt. And so with that said, we're actually going to go ahead and move into the Q&A for today. We're going to go ahead and take 2 questions. If we weren't able to get to your question today, we are going to follow up by email and answer it directly. But starting off with Chris here. Chris, if rates go down, how does that impact the riskiness of assets?
It's a really good question. The short answer is the safe assets that we're talking about here, your treasury bills, your bank deposits, your money funds, they're going to stay safe. They're just going to have a lower return. So that's it's just when rates go down, all the returns on safe assets go down. It doesn't make them more risky. Where people get themselves in trouble is they say, I'm getting less return on my safe asset, so I'm going to take a little bit more risk to get the return that I used to be able to get. And that's when people get in trouble. They say, hey, I'm going to buy some riskier bonds because treasuries don't yield as much anymore. And it's an unfortunate reality that when the returns on safe assets go down, the safe assets stay safe, but the return on everything's go down. So if people stretch for yield and they take more risk seeking return, that risk is just going to be there. So that's one thing people really should avoid.
It's a great call out, Chris. We aren't expecting markets to react as drastically as they did in 2020, obviously, but we do want you to be prepared for any environment. And so if safety is a top priority, direct investments in treasury bills are among the safest options to be in. And really, we think this is where Jiko becomes extremely relevant. If history does repeat itself and corporates rush to safety like banks or T-bills, Jiko provides a way to access T-bills directly without the counterparty and balance sheet risks that come with traditional bank deposits. And you can do that simply by wiring to the platform. From there, your cash is rolled at maturity. And should you need the money, it's always liquid and available to you. So with that said, Lisa, next question's coming to you. Beyond cash forecasting, how should corporates think about their capital structure?
Great question, Rachel. I think what organizations really need to focus on is working capital optimization. So, once you've ensured that your more liquid assets have been deployed optimally, preferably into T-bills or keeping that security, depending upon what your corporate risk tolerance is, corporations really need to evaluate other opportunities to maximize areas of their capital structure. So this can kind of help to fill some of those gaps of perhaps lower interest yields as we're having a reduction in our rate environment. So from a treasury perspective, this could mean the implementation of supply chain financing, maybe dynamic discounting, receivables financing. A lot of what we're seeing here at Kyriba is actually a hybrid combination of these programs. Kyriba actually, it enables seamless integration of these solutions with their ERP systems. And again, providing that real-time visibility and data analytics to help drive working capital performance. It also helps to manage some of our supply chain risk, unlock free cash flow, all of which is something that's, I think, top of mind for CFOs and treasurers today.
I love that answer, Lisa. Thank you. So just with the remaining time, we're going to go ahead and close this out. We have some action items here. Following the webinar, you will receive a follow-up email with the recording and a link to the slides. You can follow Jiko and Kyriba on our social pages that are linked here. We put out weekly blogs, so great place to be able to see those. Additionally, this is the first of 3 webinars that we'll be hosting over the next 4 weeks. So please follow us so we can make sure you're invited to those next webinars. And finally, if there's one thing I think we can all take away from today's session, it's this: the Fed's next move is coming. And while you can't control the path of rates, you can control how prepared you are. And so if you found this discussion valuable, we would love to get in touch. You can click on the right side of the window here and we will reach out. So with that said, I will go ahead and close us. Thank you again to our panelists and thank you all for joining. We'll follow up with resources after the call. Have a great rest of your day.